Well, major averages right now, they're down across the board. As the Dow is down 0.8%, S&P 500 1.3%, and the Nasdaq is down 2%. This comes after a hotter than expected CPI data and print that was released today, shaking investors' confidence in the strong market. But this might be a small bump in the road for an overall bullish market for the year. To begin things, for more on this, let's bring in Ryan Detrick. Carson Group Chief Strategist is here. Ryan, help us make sense of this. You always have a good way of trying to give us at least one of the bright spots to hang our hat on.
Yeah, good morning, Brad. Thanks for having me back. Listen, the S&P is up 14 of the last 15 weeks, up over 20% during that time. In the history of the S&P, we've never seen a rally like that over 15 months. Over 15 weeks, where 14 of them are higher, up 20%. So this is historic. I want to build on what Jared just said because it's true. You look at, seasonality's played out quite well. We're very overstretched. We know that. We can get into the CPI numbers, but I'm just saying we've been talking at our shop here at Carson saying, listen, maybe we're due for a well-deserved break. We've been bullish, right? We've been bullish. But when you look at it, like Jared just said, February is usually not that great, especially into an election year. And by the way, the fourth year of a new president, where we are right now, right about now, into, let's call it St. Patrick's Day, late March or so, historically can be a little troublesome. So we're not overly concerned. We think it could be healthy to finally have a little break after the rally we've seen since late October.
It's true. It used to be hard to find a bear anywhere, especially after the rally we've seen. But as you look at the reaction from markets then, is this an overreaction? Is there something else within the CPI data that's more concerning for them?
Well, that's a great point. We've been looking at it for an hour now, specifically on CPI. I mean, it's all about shelter, right? I mean, it sounds like a broken record here. It's really all about shelter. And yes, as many other guests have been talking about, you look at some of the private data, different areas, we're seeing improvements in shelter. So, I'm not exactly sure why the government's data is so different than some of the private data. We're still optimistic that we're going to see shelter start to come back. So just today, and Jared pointed it out, right? I mean, we had a little bit of a freak out with the last CPI number, but what are we seeing from PCE? It'll be real interesting what we're going to see from PPI. I believe that's on Friday. So believe me, CPI is very important, but there are other measures of inflation. I mean, just used cars. Used cars have been coming down drastically. The Manheim used car index is down like 21% from the previous peak a couple of years ago on used cars. So believe me, this was worrisome. One final comment on today's numbers. Listen, January is volatile. We tend to see more revisions the month of January than just about any other month when it comes to a lot of economic data, specifically inflation data. So I'm not Pollyanna here, but I think we're aware that this is just one data point. It's not a trend yet.
So, Ryan, as you were mentioning a moment ago, kind of going into St. Patrick's Day, March, we could see some weakness. And in this kind of broader environment where we've heard many market strategists like yourself say, look for buy on the dip opportunities, where would the strongest buy on the dip opportunity emerge if we were to see that volatility or that weakness through the end of the first quarter?
Yeah, great question there. I mean, listen, we've been in the camp last year. Came on with you guys last year saying we didn't see a recession. Not as many people believed that then. Now more have clearly come on. So if you still don't see a recession, which is our base case, we would stick with the cyclical areas, right? We think industrials, we think financials, areas that are starting to show some leadership here can do a lot better. I mean, it's not like the news has been great when it comes to banks and financials, but they've hung in there pretty well overall. And I know today, like Jared just talked about, small caps are down significantly. They had the big 3-day rally. We do think by the end of this year, small and mid caps also should do better thanks to an economy that's going to avoid a recession. And yes, rate cuts are coming. We've always said the first cut would probably be in May. We said it'd probably be 4 cuts, not necessarily 5 or 6, because the economy's stronger. And one final point on this, listen, I can talk on this on all day, make it quick. Productivity has run at a 3.9% annualized rate the last 3 quarters. Guys, you got to go back to the mid-90s last time we had productivity like that. The truth is, when you have higher productivity, wages stay high, the Fed can cut, and you don't have to worry about inflation soaring because you have a cap due to the higher productivity. So that is a key concept I don't think people have been talking about as much, and that's why we still think the Fed can cut, but again, starting in May.
And Ryan, just quickly, as we head to the buzzer here on time, in terms of what you're seeing with forward earnings expectations, how should investors, what should they make of it, and how should they really allocate their portfolio based on what they're hearing?
Well, I mean, listen, this earnings season's been solid, right? All in all, we're looking at record earnings. I mean, you guys, your daily email yesterday shared a great chart from FactSet that showed fourth quarter earnings, this upcoming fourth quarter, so almost a year from now, are expected to be up almost close to 20%. Now, there's a couple ways to look at that. Is that too high or is that too low? But the reality is, if the economy's strong, we still think this and why are so many economists now coming around to where we were? No recession, because earnings are strong, right? And we think there's still a strong earnings backdrop. So real quickly, earnings going higher, CapEx is going higher, and profit margin is going higher. All three of those things trending higher. To us, that doesn't sound like a recession. Continue to buy the dip. So we might have a little more dip here. Let's be very clear, but we'd still be a buyer.
Ryan Detrick, Carson Group Chief Market Strategist. Thanks so much for taking the time, as always. Certainly do appreciate it. And for being a reader of our morning newsletter here at Yahoo Finance. Appreciate it. Folks can see that QR code flash up on our screen all the time. Ryan, we always appreciate the time, too.
Thank you.
Thanks.